the auditorium last session yesterday at the very start? No? Only one of you. That's disturbing. You sure? No one else was? There must have been more of you. I'm sure we had about a good two. Any on two on three. Because it was fairly jam-packed and it was a great discussion. We had our fireside chat to launch that last session, and we had Guy Kelly and we had Grant Isaac, and the focus was on uranium. I found it a really interesting chat, really positive about the future of uranium, obviously taking into account what was happening in Russia, etc. Now, I bring that fireside chat up because both of those gentlemen know the fellow that's about to come up here on stage and join us. So can I introduce you all, please, first to Andre Liebenberg. Andre is Yellowcake's CEO, and as he comes up here, I'll tell you a little bit about him, because he's actually a man who's come from the dark side. He's come from the world of coal, and he's also come from the world of diamonds, and he's transferred over to this clean, pure energy that we're looking forward to being part of the solution as we power the future of the globe. Would you please make Andre very welcome, everyone?
Okay. Thank you very much, and thanks for the opportunity of presenting to you today. Let me just tell you a little bit about Yellowcake. It's a very, very simple story. Yellowcake is a London-listed company that acquires and stores physical uranium for the long term. So we buy the uranium and hold it. We don't have any exposure to mining projects, to processing risk, to geological risk, and really provide investors with an opportunity to invest in the uranium commodity directly with no other associated mining risks. We have a deal with Kazatomprom where we can buy up to $100 million of uranium per annum, essentially at the spot price. So that allows us to grow the company. The spot market is not very deep and not very liquid. So purchasing that amount of uranium would certainly move the price a lot. We store our uranium in Canada and in France. In Canada, it's at the Cameco facility just outside of Toronto, and in France with the Aura facility. There are only 3 facilities in the West where you can store physical uranium, the third being in the US. And we have a very low cost structure. We've only got 2 full-time employees. We've outsourced our transactional activities, our IT, and our bookkeeping and accounting. And we really target a cost base or cost leakage, if you will, of less than 1% of our net asset value. Last year, because we grew significantly in the year before, our cost base was about 0.6% of net asset value. And talking about net asset value, if I just turn to our balance sheet quickly, and you'll see that we own on a pro forma basis about 20 million pounds of uranium. At the current spot price, that is about $1 billion. We have an additional about $18 million of cash. So our net asset value is just over $1 billion at today's prices. And that's all we have. We don't have any debt structures. We don't have multiple classes of shares, and we don't have any hedging. Now, when we IPO'd in 2018, we took a view that uranium was a commodity. Commodities are cyclical, and uranium was at the bottom of the cycle. At that stage, uranium was about $20, $21. And underpinning that thesis was the supply-demand fundamentals. We saw a visible and growing demand side, and we saw a supply side that was struggling. Now, as we fast forward to today, so in the intervening almost 5 years, there are 4 factors that have driven that demand side. So when we IPO'd, demand forecasts were about 1.5% per annum. Today, they're more like 3.5% per annum. And that is driven by the climate change and decarbonization goals that many countries are adopting. I think more than 70 countries have adopted these sorts of goals. And on the back of that, we are seeing a rapid increase in reactor build programs. We're also seeing countries supporting their existing energy fleet and nuclear fleet and the advent of small modular reactors. Since the Russian invasion of the Ukraine last year, energy security and energy independence has become a significant issue. And this has impacted uranium and nuclear in a positive way. Long-term contracting, this industry runs on long-term contracts, and we are starting to see long-term contracting returning to levels where it needs to be in order to replenish inventories. And finally, talking about those four positive demand factors, the supply side continues to struggle. So when we IPO'd in 2018, there were a bunch of projects that were on the table. All of those projects are still on the table. Not a single project has advanced in any material way in terms of putting the asset into production. So we do see this as a supply side challenged commodity, and therefore uranium prices need to increase. Quickly on the climate change side, we've seen a number of countries adopt climate goals. Nuclear power generates the least CO2 emissions compared to all other energy sources. And that is now being appreciated. Nuclear is being appreciated for its low carbon, reliable, base load energy source in terms of meeting those decarbonization goals. On the back of that, we've seen aggressive reactor build programs, particularly in China, India, and the Middle East. If you go back 10 years, China had 18 operating reactors. Today, they have 55. They've got 21 under construction. They aim to double their reactor fleet by the end of this decade. Is that doable? I believe it is. China is building reactors, in around 6 years. They've developed the expertise to build these on an industrial scale. And it's not just China. We're seeing build programs in India, in the Middle East. But beyond that, the traditional nuclear countries of the US, Europe, Japan, we're seeing there an appreciation of that existing infrastructure. The Inflation Reduction Act in the US is significant. It's providing a lot of money to support the existing reactor fleet. In Japan, we're seeing restarts. In Europe, we're seeing Finland, Sweden, France, the Netherlands, Belgium, all really looking at their nuclear fleet and making plans to support and extend the lives of those fleets. Just turning on to small modular reactors, that's a very exciting development in the nuclear space. And it's very real. We believe it is. There's something like 70-odd reactor programs being developed by countries such as China, the UK, US, Canada, by big companies such as GE, Hitachi, Rolls-Royce. We believe that this will be a reality by the end of the decade. There are a few reactors already being constructed, and there are existing reactors on ships that are powering cities in the Arctic. So this is becoming a reality, and the Barclays Bank investment research team believe this could be a $50 trillion, or a $1 trillion market by 2050. Let me just talk about energy independence and energy security briefly, and about Russia's role in the nuclear fuel chain. As you can see, that the nuclear fuel chain goes from the mining side, where we produce U3O8, which is the product that we own and hold. It then gets converted into a gas, enriched, and reconverted back into fuel rods and fuel bundles. If you look at the conversion and enrichment cycle, Russia is about 35% of global capacity in conversion and 45% of capacity in enrichment. So a material player in the nuclear space. And the Russian invasion of the Ukraine last year was a game changer in the nuclear industry. I think, the Western utilities suddenly realized how beholden they were to Russian fuel. In the US, something like 20% of the nuclear fuel that goes into the US comes from Russia, and in Europe, that's about 30%. So we're seeing a huge swing by Western utilities seeking Western sources of nuclear fuel. Russia's not a very big player on the U3O8 side. They only produce about 13% of global supply there, but much bigger on the nuclear fuel side. So with that, we are starting to see a deglobalization of the nuclear fuel industry. Going forward, it is very likely that Western nuclear utilities, Japan and some other countries, will seek to remove themselves from Russia and will seek Western sources. The problem is that these Western sources don't exist today, and they'll take time to develop. Now, conversion and enrichment are industrial processes. The technology is available, they can be developed, but it will take time and it will take money. To date, there has been no sanctions on Russian nuclear fuel. So Russian nuclear fuel is flowing into the US and into Europe without any sanctions. But that sanctions pressure is building. In the US, we've seen a bipartisan bill being presented to sanction Russian uranium. And in Europe, the European Parliament is also looking at that. Now, those bills haven't been approved or seen the light of day, but it's a sense that there's a possibility that Russian fuel could be sanctioned. And I guess evidence of the concern of governments around uranium independence and security, US government has started procuring uranium for a strategic stockpile. They recently purchased just over £1 million from 5 US producers and paid over 30% above the spot price to secure that material. I talked about long-term contracting. This industry runs on long-term contracts. So utilities procure about 85% of their fuel needs under long-term contracts. Historically, we've seen low rates of contracting. So reactor fuel burn is around 175 million pounds a year. And the contracting rates recently have been around 70 million pounds, which has led to a depletion of inventories held by utilities. Last year, we saw a 60% jump in contracting. The level was around 114 million pounds. I think that number was underreported. It's probably closer to 130. And I think this year we're going to see a number above that. So going forward, we do see a number of years where contracting has to reach replenishment rates and probably in excess to rebuild inventories. And putting all of that together, going back to my earlier point about this being a supply challenge industry, if you look at supply and demand and just focusing on that yellow box in the middle, the estimates are that by the end of this decade, we're short of 33 million pounds of uranium per annum. Now, bear in mind that Kazakhstan, which is the world's largest producer of uranium, 42% of global production, produces 55 million pounds. So you almost need another Kazakhstan by the end of the decade. And that assumes that these probable projects that represent almost 26 million pounds all come on stream. And we know in the mining industry that, bringing projects on time and on budget, the industry doesn't have a great track record in that regard. So I guess just pulling all of that together, we believe Yellowcake is very well positioned. We only hold physical uranium. We don't have any operating risks. We've got a very small team and a very low cost structure. And we're seeing, the mood swing towards nuclear in terms of decarbonization, energy transition, now more recently, energy security, energy independence, and the appreciation of nuclear's role in those two regards. So, Yellowcake owns 20 million pounds of uranium. We will look to grow that over time. We issue shares at a premium to equity, a premium to net asset value, and don't issue shares when we're at a discount. So we're very excited about these, confluence of events which are driving the nuclear space. Thank you.
Thank you very much, Andre. Really interesting chat. Technology Metals is next up on stage. They're developing their Murchison Technology Metals project in the Midwest of Western Australia, and that is a long-life, high-grade vanadium project. We're back to vanadium, producing a high-purity product for both the steel and battery markets. Do you know that the original Model T Fords are still tootling around because they've got in them vanadium? It's very hardy, that's right. So back to this vanadium in 2023, Technology Metals Australia has recently developed its maiden batch of vanadium electrolyte, which is suitable for use in vanadium redox. Did I say that right? Redox flow batteries, excuse me. An important long duration energy solution that's going to help the world on the net zero journey. Would you please welcome this fellow, Managing Director, Ian Prentice. Welcome, Ian.
Thank you, Chrissy, and thanks everyone for joining us this morning. Thanks to the team at Resource Connect Asia for inviting us along. So Stewie and Prue and Jackson, thanks very much. And of course, the lead sponsors, Tribeca and Argonaut. So we are going to be talking about vanadium, and we're going to be talking about vanadium for a cleaner future and developing a vanadium project in the middle of Western Australia. When the button works. There we go. So this is available on our website, so I'll let you read that at your leisure. So vanadium is supporting our move to net zero. So vanadium, as one of the speakers in the previous session, Vincent Elgar, talked about, primary use at the moment is in steel, and it has a really big role to play in reducing carbon emissions related to steel applications. But where the real future is, where the real opportunities are, is in large-scale stationary storage batteries. So the vanadium redox flow batteries, and that's really, as Chrissy was saying, a market that we're very focused on. So, as I said, located in the middle of Western Australia, so a great spot to be. Just, I guess, some real key points. You know, it is all about the geology, and one of the earlier speakers yesterday talked about, you know, we've got the rocks. So it is about the geology, having the right geology, the right metallurgy to enable a very, I guess, reasonably straightforward process and at the right cost point. We are looking at doing conventional integrated processing on site. So we take it from those rocks all the way through to our final vanadium pentoxide product, so our high purity product that then will be able to go into that battery market. And I guess one of the real key things we achieved earlier this year is we've now got some financial support from the Danish Export Credit Agency. So EKF are supporting us to the value of around 150 million Aussie dollars for the development of the project. Corporate overview, we listed in December 2016, so we've been around for a little while. We had $12 million cash at the bank at the end of December last year, but still only 210 million shares on issue, so quite a nice tight structure. The other key takeaway from this slide is our major shareholder, Resource Capital Funds. So Resource Capital Funds came on in a capital raise we did in September 21. Raised $20 million, which was our last capital raise. They're sitting on our register with touch over 17% of the shares in the company. So fantastic supporter. They did a lot of work to understand the vanadium market, did a lot of work to understand where the entry point was, and they chose us back in September 21 for that investment. Experienced board and management, that's I guess the standard quote, but I guess one of the real key things for us is our operations or our project readiness team. So again, Eddie Rigg talked about it this morning, is it rocks or people? And I tend to agree with him, different stages of projects, it is rocks or people or both. We're in that study and implementation phase. So we've got a guy called David English on our team, so our Chief Operating Officer. David was actually the guy who built one of the mines that Eddie was talking about, DeGrussa for Samphire. So very, very experienced project developer in the West Australian market. And also really key for us, he spent 2 years at the only previous operating vanadium project in Western Australia at Windermere. So he's got both the project development as well as the operating background. So really strong part of our team, and he's building a really, really good execution team around him. Sustainability and our ESG, very, very important for everything we do, as has been from the very beginning. Clearly the focus is from an investment point of view has moved more and more into this space. And again, I guess, you know, getting a Danish Export Credit Agency support really does show that we've moved a long way in developing up our ESG. We're working with WSP Golder on really being in a position ready to go on that construction and really supporting that ESG profile. So really good engagement with our local community, our local Indigenous community, and a very strong focus on our governance. One of the other things we've really focused on in the last little while is building a really strong, I guess, partnerships around us. And again, one of the things that Eddie commented on when you're in this phase, in this pre-development into moving to development phase, really, really important to have those strong partnerships. So we've got an MOU with Tata Steel that we entered into last October, which is really focused around the steel market. We've also got a really strong relationship with a Japanese vanadium electrolyte producer, LE Systems. So really good access into those markets. And on Monday of this week, we announced a MOU with an Indian vanadium redox flow battery company, Electric, which I'll touch on a bit further, but really strong partnerships that we're developing with end users in our market. So really, really important. And on the other side of that slide, we talk about EKF, which I've mentioned with that funding support. That's linked to FL Schmidt. FL Schmidt are a Danish mining equipment provider. They are the leaders in vanadium processing technology. So we've been working with them since 2018. So really important relationship there. And that, as I say, links back to then EKF supporting the funding and development of the project. So a tier one project in a tier one location, I won't go into too much detail around that, but a couple of the key points for us, shallow weathering, which is really, really important when it comes to our processing, and I'll touch on that in the next slide. Conventional integrated processing. So this is the processing that is actually happening as we speak in other parts of the world. So we're going to be adopting what's already tried and true and known in the world of vanadium. And high purity vanadium product, as I mentioned, so that'll be 99.5% ideal for the battery market. But also for the first 9 years, we'll be producing an ilmenite byproduct, so a titanium dioxide byproduct, which really from a funding point of view helps to de-risk the project, having that dual revenue stream through the process. And the bottom bullet point there, the numbers we've been working on, you know, we're close to about 200 million Australian in EBITDA every year for 25 years. So very, very strong financial metrics around our project. This is really important, and I guess it sets us apart from a lot of our peers in the developing vanadium space. This ability to have fresh ore close to surface. Fresh ore is really, really important in the processing. It means that we don't have to really fine grind our material. We get a really high recovery, so we don't have to be overly capital intensive at the front end. Our actual yield into a product is really important and really high compared to a lot of our peers in the industry. So really sets us up well. And again, goes back to that point of being able to then just use conventional processing, which is out there and operating. So long section through our main Gabonite deposit. The red line is the base of oxidation. So we can see, particularly on the north end there, it's a very, very thin veneer before we get into the really high yielding material. The section on the right-hand side is our Yarrabubba deposit. So it's a cross section through that, showing that variable, I guess, the oxidation profile. But in the pink unit there, that's our high grade unit. That's the economic driver of the deposit. Very, very shallow oxidation in that area as well. So really important to differentiate us. Touch on this quickly. I guess again, you know, we've heard this through a number of speakers over the course of the last 2 days about the geopolitical situation we're in. Vanadium is a really interesting one in that 61% of supply has historically come from China, and then 16% come from Russia. So you put that together and you see a huge amount of supply that's coming out of those two jurisdictions, which clearly when we're looking at security of supply chain, end users are looking for diversity. So we sit there in Australia. Australia hosts around 18% of economic resources of vanadium in the world and currently have no production. And so we're going to fix that. We'll be the first new large scale vanadium project to come online. The obligatory cost curve. So this is numbers from last year. The blue star there, hopefully you can all see that. That's where we expect to be. So we're right down the bottom end of the cost curve. So ideally placed, again, a long life asset, 25-year life as it stands today. You want to have that low cost profile so you can go through all the cycles over that period of time. The other key takeaway from there is that on the right-hand side, some of those higher cost producers are actually at costs above what the current vanadium price is. So you can see that from that to enable increased production, we're going to have to be looking at a higher price, and that incentive pricing comes into the equation. So primary uses of vanadium, I touched on it earlier. Primary use currently is into steel, into construction steel, majority of. There's also a really strong use into high purity vanadium going into specialty alloys for the aeronautical industry. And right now that's a big driver of the market because I guess the rebound in the aeronautical industry has happened much quicker than what everyone expected coming out of COVID. So at the moment that's putting a bit of pressure on the vanadium price. But the couple of pie charts there are really illustrative of why we're targeting the battery market. So this comes from CRU, who've done some work for us supporting our studies that we're in the middle of, saying basically from 2021, when 90% of vanadium went into steel, by 2040, they're expecting 75% of vanadium to go into batteries. So massive growth in the overall market, but also massive growth in that application. We're looking at, by the beginning of next decade, around 45,000 tonnes per annum shortfall in supply. And putting that into context, we're about a 12,500 tonne per annum producer. So there's a big opportunity for a number of us to get up and running by the end of this decade and really feed into that demand equation. Bit of context around what's happening in the battery space. So one of the big things that's really emerging, and we in the industry we've understood for a while, is that China's really driving some really large scale batteries. So long duration storage, really big batteries. But the numbers only really came to light in the last month or so of what they're actually putting into the, you know, volumes that are going into these. So we see in 2022, there's something like, you know, 6 or 7% of supply, of global supply went into batteries in China in that year. And they're forecasting that to increase to 15,000 tonnes in the current year, which is getting up there, you know, sort of 8 or 9% of total supply. And again, we'll be producing 12,500 tonnes per annum. So putting that into context, it's we're a significant producer, but in the context of that demand side, we're quite modest. The US Inflation Reduction Act, and a lot of people have been talking about this, again, driving a big demand into this space, and a lot of the offshore battery developers are moving into the US, including Sumitomo Electric, to really support that growth. And there's going to be a big number of applications into that space. Chris, you raised this right at the beginning. We're looking at the downstream. We're looking at adding value to our vanadium in Australia and then beyond. And we're working with LE System, which is a well-established Japanese vanadium electrolyte producer. They've got an operating facility up in Fukushima, which we visited last year. We've been working with them for the last couple of years. And earlier this year, they took our product all the way from raw ore through to high purity vanadium electrolyte. So really ticking the boxes and confirming with end users that we are in the right space as far as producing that electrolyte. So we're working with them to develop our downstream in Australia and beyond. And then, as I mentioned, you know, we've got a key partnership announced at the beginning of this year with a group called Dielectric. So Dielectric's an Indian group that is developing these vanadium redox flow batteries that are, again, on an exponential growth curve. So I think a couple of years ago, they were talking about single-digit batteries being deployed. This year, they've already got 100 VRFBs on their order books. So massive growth. They're recognising that they need to be partnering up with primary producers like ourselves to make sure they've got product to feed into their growing demand. They're also active in Europe, Saudi Arabia, North America. They've got established an office in WA, so they're really pushing out into the international market. They're actually putting a battery into Europe, which will be around supporting a EV recharging station. So solar generated power going into one of these batteries and then driving through to EVs. Right. Where are we at? So we actually completed a feasibility study on the project back in 2019. We've done some work on refreshing that and came up with a new reserve in August of last year. We're now in what we're calling the implementation phase of the project. So moving through, we've engaged with our key partners from a project level to work alongside David. We're working with our traditional owners to make sure that they're really included in what we're doing for this long-term project. And that ties into the permitting. And again, a big common theme for the last couple of days is progressing those permitting sides of things. And that's a big key focus for us. And it is all about being in a position so we can really move this implementation phase through. So I think, you know, we believe very strongly we're a compelling investment. We believe very strongly we're going to be the next primary vanadium mine coming online. And, you know, we'd like to see some, you know, significant progress being made in that space over the next 6 months or so. We've got a reserve upgrade coming in the next little while, and that'll flow through to updating of our financial model, which will put us in a bankable position to supporting the funding requirements. But, you know, we are industry leading tier 1 project, quality management and team around that to bring that through to fruition. We are a critical mineral supported around the globe. Australia, US, Europe as identified as a critical mineral in the space. We've got a great team to deliver on that. And, you know, with partners like RCF and partners like EKF, we're actually really well placed to bring the project through. So thank you very much.
Well done, Mr. Prentice, well done. All right, if you are interested in pegmatites, lithium, calcium, tantalum pegmatites in particular, Colin Locke is in our other auditorium right now, Krakatoa Resources. There's been a lot of news on them and a lot of news coverage on them in the last couple of days, so you might want to go in and check out what that's about in relation to their King Tamba project, which is over in Western Australia. In here, we're going to talk Aura Energy, and joining us on stage is MD Dave Woodall. G'day, Dave.
Chrissy, thank you.
Oh, and you're going to talk to us about uranium today because they have got an Australian-based significant near-term low-cost producer. That's a bit of a tongue twister and a half for me at this time in the morning. That has major long-life polymetallic and uranium projects with large resources in one of my countries close to the heart of chocolate over in Sweden. Would you please make Dave very welcome today as he tells us the story of Aura Energy.
Thank you. Today I'll talk about Aura Energy's strategy, what we're doing, and differentiate what Aura is and its assets to many of the near-term producers. So what's the highlights? We're targeting to become a significant near-term producer. We've got nearly 60 million pounds of U3O8 in the ground. We've got our permits in place and we're starting to progress to get into production by the first quarter of 2025. We've just finished a enhanced feasibility study. That feasibility study has shown the robust economics that we believe this project will deliver. We've got low capital and operating costs, and that is significant, as I'll talk in more detail, that drives this project. It's an open pit, shallow digging, no crushing, no grinding, and it delivers a excellent margin with all-in sustainable costs lower than $30 a pound. As many speakers have been talking about, this has been driven by the global market to decarbonise, of which nuclear will play a significant part in it. The EFS has been focused predominantly on what we call the Tourist West, and some 250 kilometres to the west, we've got the Tourist West area, which has slightly higher grade, and we will start focusing on bringing that into our project and operation as we move forward. Our Häggån project in Sweden, and I'll talk about some of the noise that's occurred in the last couple of days. This is a large, multi-decade operation. It contains your key battery metals in vanadium and nickel. It also has zinc in it, has uranium in it, and has a byproduct of sulfate of potash. So in the heart of Europe, in the heart of Sweden, there's a mine that'll be around for close to a century. We've progressed off-takes. We have an off-take that we signed in 2019. We are continuing to progress off-take, and we're starting to look at the financing component, which is targeting an FID decision later on this year. Corporately, 558 million shares on issue. We've got 6.3 million in the bank, so we spend about $500,000 a month, so they've got plenty in there to do what we need to do. And we're looking to grow in the two areas of Sweden and Mauritania. The strategy is based in a series of short, medium, and longer term objectives. In the short term, between now and 2026, we're looking to build the Tourist project, get it up and running at 800,000 pounds of uranium per year, then look at additional resources that we're pretty confident exist in this area, and then advance to the construction and expansion to over 2 million pounds of uranium at Tourist. We will progress Häggån to get through an exploitation permit and then into the permitting phase, and we will assess other opportunities as they come through. By 27 to 30, we'll be producing consistently 2 million pounds of uranium. We should have a Häggån approvals in place, and then we should be looking at, similar to many of the vanadium producers, looking to go downstream in a strategic alliance with other parties. Beyond 2030, we see ourselves expanding in Mauritania and developing and getting the Häggån project into operation. So for a small company like Aura, we've got a great pipeline of growth that we believe we can deliver on. I won't talk much about the global market, but just to point out a point. So far this last couple of days, I've heard anything from 162 million to 170, and talking to a few people in North America in the last couple of days, they're predicting that the actual demand for uranium in the last year is about 235 million. So let's assume it's about 162 million as it's stated. Yeah, we've talked just recently about what's being planned. Some in construction, proposed and planned is some 507 nuclear reactors. If we put the skeptics aside and say, well, what is China looking to do as a part of its process to get energy security in that country? Half of those are in China. So all I can say is that the demand that's going to drive this industry is somewhere between 80 and 162 million pounds that needs to be developed and produced. That's the growth that we see in this area. So let's look at Mauritania. Our tourist project, some 1,450 kilometres to the northeast of Nouakchott, the capital of Mauritania, has significant leverage to the uranium price. It's a low capital cost. It'll cost just under 90 million US to get into production. It'll produce 800,000 pounds a year, and then we'll expand that by a further 90 million to have a 150% increase in production to 2 million pounds a year. It's shallow, free dig. There's no crushing and grinding, so we've got excellent margins. At the moment, with about 50% of our resource mined, we've got a 16-year mine life. In near term, we've got offtakes in place. We're progressing those offtakes. We're starting to engage into the financing of the project. Our front-end engineering design has commenced and is due to be complete in Q3, Q4 this year. We're fully permitted. Our ESIA has been approved. And in the last month or so, we announced that we were able to successfully get issued the 2 key mining conventions, which give us fiscal stability over the next 30 years in Mauritania. So we're well placed. Mauritania, not many people know where Mauritania is. When I talk Mauritania, they talk about Mauritius and a number of other countries that exist. But it's got a well-established mining law. You've got people like BP and Cosmos Energy that are developing a massive offshore gas field that's coming into production this year. There are several other offshore gas fields that are looking to be developed. BP just recently announced they will go to the second offshore gas field and develop that. It's about $2.5 billion US to develop. There are good roads and infrastructure. There's companies like Kinross Gold there. You've got First Quantum. So it's not an unknown to this resource area. And Mauritania is going to play a significant part in the global energy solution. It's well situated close to Europe, not too far away from the North American, and it has an ability to grow a successful country. We have a strong partnership with the Mauritanian mining company, Anapam, who own 15% of the project, and we're working collaboratively with Anapam to progress this project forward as quickly as we can. So let's just talk briefly about some of the mining. It's shallow mining, so the average pit depth is 4 meters. So we'll get an excavator that can dig about 7 meters, which is the deepest part of these deposits. There's no drilling and blasting, which is some 15 to 20% of mining costs. And 85 to 90% of the material gets placed directly back into the mined out areas. So the environmental footprint is significantly reduced. Those benefits of shallow mining, no drilling and blasting, have an impact on the cost within the mining area. And we've got a strip ratio, including internal waste, of less than 0.8 to 1. In the processing, the run-of-mine ore gets delivered to the plant, a beneficiation plant. We put it through a feeder breaker. We then put it through a rotary scrubber. We add water, and then we filter anything from -75 to -150 micron. 90% of the uranium goes direct into our leaching plant, which is pumped some 6 kilometres down a pipe system. So no crushing, no grinding. That has significant benefits in terms of capital costs to develop the mine. And the other component is because only between 10 to 15% of the material from the mine actually goes into the leaching component is a lot smaller. That's the difference between what Kras is and most near-term uranium producers. It has capital and also operating cost benefits. In our operating costs, we see life of mine C1 costs at about $25 a pound and all-in sustaining costs of under $30 a pound. So a great opportunity to develop strong cash flows. Our capital expenditure, as I've spoken, is 87.9 million on the initial phase. And then once we get that settled down and into production, then we'll go into an expansion and spend another 90 million to get it into production. When you talk to finances, they talk to you about two key issues. The first is your project delivery risk. Well, at $80, $90 million, we can mitigate that risk importantly. The other risk they talk about is your operational readiness and getting into production. And the ability to have a smaller project at the start to get the operators trained, the knowledge transfer, to get the right technical people into this area gives us confidence that the model we're putting together is going to allow this project to be very successful. And you note that the feed grade into our leaching plant is over 2,000 parts per million. I'll just briefly talk about, that's the startup, 1.25 million beneficiation plant from run of mine. Then you've got 230,000 tonnes of that material goes into your leaching. In the back end, we've got a 3.5 million pounds of capacity, and that's really looking at what's the benefit of building a smaller one versus what would be an average size plant. That then gives us, as we ramp up, we can put additional beneficiation plants and leaching. In the feed study at the moment, we're in the process of further optimising this to find out where the real constraints and bottlenecks are in the system and allow those to get further added value. On the exploration side, this is the Kras East area. Kras West is some 250 kilometres out to the west. And you can see the blue shade, the blue areas highlighted. That's where the resources are. The black are areas that are radiometric surveys that historically we've found about 1.3 million pounds per square kilometre. Also, I'd note that to the right of this red line here, there's been no radiometric surveys done. So we're pretty confident on near-term exploration success as we move this project forward. In Kras West, the average grade of Kras East is about 235 parts per million. In Kras West, it's somewhere about 300 to 400 parts per million. So as you build this project and move it forward, we believe exploration has got great opportunities in this area. And then what we do is put an intermediary product, bring it back to our central plant and produce a U3O8. What are we doing? I'm not going to go through all of this, but basically feed studies on track. That's on track to be completed in the fourth quarter this year. We're looking to do a financial decision in Q1 where we've identified the long lead items. We'd look to be placing orders for those to ensure that we get the project delivery on time, and then we'll progress to starting commissioning in late 24 and then into commercial production in early 25. Just briefly on the Hagorn, this is a massive, about 2.5 billion tonnes of resource, vanadium, nickel, zinc, molybdenum and uranium. And as I said earlier, in the chemistry that we do, we actually recover a sulfate of potash. We've got a scoping study that we'll release in the next couple of months, which will show what we think the value is. And also with some work that's happening within Sweden, we're pretty confident that we should be able to extract the uranium with community and government support. And it'd be remiss of me to not finish off to explain that whilst that it was reported that the Swedish government had rejected the ban, not moving on the ban of uranium, is actually incorrect. private members' bills were rejected, which is typical of most democratic countries where the government wants to control the agenda. As I say, significant near-term uranium producer. It's got low capital, low operating costs, with easy and great potential for scale, and it's been driven by the global decarbonisation that's occurring around the world. Thank you.
Thanks, Dave. We're moving over to lithium now, and Lake Resources is taking to the stage. They're a clean lithium developer utilising proven ion exchange extraction technology for production of sustainable, high-purity lithium from its flagship Kachi project within the lithium triangle, which of course is in Argentina. So they have appeared up on the screen once already at this conference on Mr. Joe Lowry's famous lithium triangle dot picture that he put up yesterday. Let's hear the details. Would you please make Peter Nilsson, the CFO, very welcome, everyone.
Good morning, ladies and gentlemen. It gives me great pleasure to present to you today on behalf of Lake Resources. A bit of housekeeping first. I'd like to point you to the disclaimer and encourage you to read this at your leisure, as I will be making some forward-looking statements. Lake's view on demand for high-purity lithium is that the supply and demand will not be in steady state until we reach 2040. As you can see on the diagram on the left-hand side there, that the compound annual growth rate won't start to settle down and even out at around 9% until 2040. On the supply side, DLE and direct lithium production technologies are expected to accelerate the scalability of supply. Timing of projects coming online is unpredictable, and more projects are moving to the right on the timeline for various reasons. High demand for non-Chinese supply, driven by the fact that companies and countries are looking to establish independence, and also the lack of lithium battery alternatives at this particular point in time. The Lake story. Lake is a 6-year startup. We have offices in Houston and in Argentina, and we're listed on the Australian Stock Exchange. The Kachi project, which is our flagship project, started out in a pre-feasibility study to produce 25,000 tonnes per annum. However, this time last year, due to demand, resource size, and attractive economics, we decided to produce a definitive feasibility study based on 50,000 tonnes per annum. Kachi has a large resource, which is yet to be completely defined. We updated our JORC statement in January this year, where we doubled the measured and indicated resource. Our path to production is defined, and we are at this point in time working towards completing our definitive feasibility study. Current management team is reviewing the execution plan to ensure that we have a successful project. DLE, but more specifically, ion exchange, uses significantly less water, not only because we re-inject the brine back into the reservoir, but also the amount of water that is needed to complete the process. As with any project, we need world-class partners, and I'll talk about our world-class partners in a slide, a few slides' time. We've also increased our management team significantly over the past 6 months, and we've increased our strength in areas such as construction, processing, drilling, people, and industrial relations. All play an important part in moving the Kachi project into production. Not only have we looked at the management team, but we've also looked at the board, and we brought on 3 new directors to help us transition from exploration and evaluation to development and then through to production. And a part of bringing these 3 new directors on board, we've also increased our governance and oversight. As you can see on the diagram on the right-hand side, we operate in the lithium triangle, where you've got Bolivia to the north, Chile to the left, and Argentina. This blue dot here is where we have 3 projects, our Calchari, Olaroz and Paso. They are in early stages of evaluation, and they are up in the Jujuy province. However, the main focus is on the Kachi project, which is the bottom dot here, and moving that from exploration and valuation and into development. We have recently released their new JORC statement, doubling our measured and indicated from 1 million to 2.2 million tonnes of lithium carbonate equivalent. Further drilling is required to fully define the resource, as the resource is open in all directions and at depth. Our technology partner, Lilac, has successfully been operating a demonstration plant on site since October last year. The demonstration plant has run for well over 2,000 hours now, and also is very near producing the 120,000 litres that is required under the conditions to operate the plant. The results of the first batch of the lithium chloride, which was processed at Saltworks in Canada, we released the results of that process on Monday, and it was very significant milestone for Lake Resources, with the purity coming back at 99.8%. We're currently working on capital costs and timing to first lithium, which will be all part of an operational update that will come out at the end of Q2. On the screen here now is a flow diagram of what the process will look like when completed on site. With the ion exchange technology, the process from brine to lithium becomes faster, scalable, high recoveries, and sustainable. Faster, so when the brine first comes into the ion exchange modules, 3 hours to when we produce lithium chloride. Scalable, so the very design of the ion exchange is modular, so that we don't have to build one big ion exchange module to produce 50,000 tonnes. We will produce multiple modules. Recoveries, we're finding that we're receiving recoveries of around 80%, which also helps us maximise the value of the resource in which we're operating. And sustainable, low water usage in the production process, and then the re-injection of the brine back into the reservoir. The diagram on site there, the photo probably doesn't do justice to the size of the salar in which we're operating. And the dirt road that you can see there, that goes off to the right, which is where we currently have our office and camp. Much of the land required for the production and the process plant will be in a footprint of 500 metres by 800 metres. This is replacing the about 30 square kilometres of evaporation ponds. Brine re-injection back into the resource to ensure no change to the water table, which is significant for the fresh water that sits on top of the brine, but also the people who draw from that fresh water table in the 2 towns that are located near where we're operating. Local communities are already benefiting from employment and training, but not only training for our employees, but also the local people in the communities on how to run a small business. We talked before about world-class partners. We've briefly touched on Lilac. Lilac have the ability to earn up to 25% stake in the Kachi project, which they are well on track to do at this particular point in time. Funding, we have expressions of interest from the United Kingdom Export Credit Agency, their counterpart in Canada, EDC, as well as Citibank and JP Morgan, to fund up to 70% of this project. With the significant ESG benefits, it also lowers the cost of that funding. The loan term will be 8.5 years post-construction. We have 2 offtake partners who will take 25,000 tonnes per annum each in this project. And not only will they take 25,000 tonnes each to fully commit the offtake for this project, but they're also going to take a strategic investment of 10% each in Lake Resources. We have 4 milestones that we would like to achieve in 2023. We have already achieved one of those milestones with the report on the purity of our product from the lilac process ion exchange from the saltworks conversion. In late May, we'll come out with the operational update, and that operational update will come out with capital costs to build this plant and also time to first production. We are working, the management team focus at the moment is on completing the definitive feasibility study, and that will be out June, July this year. Not long after we have the completion of the DFS, we will also have the completion of our environmental impact assessment and the lodgement of that document with the Catamarcan government. Thank you very much.
Thank you very much. You were very, very quick off the mark there. Did you want to take a question from anyone since you've got a minute up your sleeve? No. Would you like them to come back and have a beer with you later today and talk more in depth then? All right. Okay, let's do that. Would you put your hands together again, please? Well done, team. Now, as you can see, the chairs are moving back on stage behind me, so we will dim the lights again and we're going to go into fireside chat mode. So I would like to call up to the stage, please, our presenters. For this one, we are running a little bit early, so if they're up the back, I will understand completely. But we've got Tim Campbell, who is the VP ESG and Corporate Secretary for Global Atomic. Monica Kras has joined us. She's the VP Corporate Development for NexGen Energy. And leading the conversation today, we have the inimitable Mr. Guy Keller, our Portfolio Manager from Tribeca Nuclear Energy Opportunities, joining us up on the stage. And possibly not, this is where you're going to find that I do not have the necessary knowledge in these particular subjects with which to cover. So we'll just say, if you'd like to have one of those little pomodoros that we were talking about yesterday for a minute, rearrange things on your page and just have a little bit of a break, and I will go outside and just chase them up because we are running 5 minutes early. And the nice thing is you now get to just spend a bit of time by yourself, recalibrate, and then your brain will be all ready to take on the next bit of information. So just give me 2 minutes and I will go and grab them for us. You can even talk. How's that? I'll let you talk in the auditorium. There we go. Right, I found them, everyone. So just recompose ourselves, leading the charge. We can see the inimitable Guy Keller taking to the stage first. There should be a microphone on everyone's seat, team. We've got half an hour up our sleeve. Guy, I'll give you a 5-minute bell towards the end. Joining us in the middle, we have Monica, and coming up at the rear there is Tim. Guy, you're in charge of guarding. As I said, 30 minutes. I'll ring the bell at 25 minutes. Do you have some notes carefully crafted? That would be handy.
What are we going to talk about for 30 minutes?
I'll give you a title and you see how you go with it, okay? So the title for your fireside chat, as we imagine the fire burning behind you, is Delivering Fuel for a Clean Energy Future. That's your cue. The next 30 minutes is up to the three of you.
That's exactly what's happening. And thank you, everybody. And still good morning or good midday. So yes, we're back here again today to focus on the nuclear sector and the future-facing commodity that provides that raw material to give us all carbon-free baseload electricity for years and years and years to come. So I'm privileged to be able to sit up here with two of our companies, two Canadians who've graciously made their way over here to Asia for us, Monica from NexGen and Tim from Global Atomic. What what we might probably do, I think, is just start with a little bit of an introduction from both of you as to, you know, your company, where your project is, what stage we're at with that project, because we're not in the echo chamber of a uranium or nuclear conference that we're all used to attending, where everybody knows the stories quite intimately. So Monica, we might just start with you, and you can give us a brief introduction on the company.
Hi, I'm Monica Kras. I'm from NexGen Energy. We are a uranium asset in Saskatchewan. We're the lowest cost, biggest uranium development company in the world. We have 256 million pounds of uranium at 3%. So that's 30 times the average grade. So we'll be in production in 2027, and we'll be producing about 30 million pounds a year.
Okay, so to put that into perspective, we're roughly around 180 to 200 million pound per year consumption. At the moment, the producers are doing around 125 million pounds. By 2027, we will see that demand going up through 200 million pounds. And so when the Arrow deposit starts producing, we talked yesterday, I don't know if anyone who was here yesterday, but there's 50 odd reactors being built at the moment. And the requirements of those reactors that are coming online the next 5 years will basically equate to the output of the Arrow deposit. So very significant required asset that needs to come to market. But it still doesn't actually solve the primary mine supply deficit problem we have to fuel the existing fleet. So we'll move on to Tim Campbell from Global Atomic. Tim, if you wouldn't mind.
Thanks, Guy. Tim Campbell from Global Atomic. We're located in Niger, West Africa, and we have a high-grade uranium project there, high-grade for African standards, not quite like Monica's, but we're working towards production in January, Q1, let's say, of 2025. Yeah, we'll be running at about 4.5 million pounds a year. And so speaking to Guy's point, they're looking to fill the supply deficit that's fast approaching.
And we all know that uranium obviously it's a raw material that's producing carbon-free electricity. However, for mining methods, there's still a focus on the environmental standards. Monica, perhaps you could just talk about the uniqueness of how you guys plan to mine the deposit and just with minimal surface area disturbance and how that's sort of unique and how your approach.
Yeah, so we're blessed with a basement hosted uranium deposit. So this is pretty unique in the context of the uranium market in general. So there have been two other mines, the Ranger mine and Eagle Point, that were also basement hosted. Due to this, we're able to have a very low surface area footprint. So we're only mining 1,300 tons per day. So to give you an example, it's 2 small rooms. I would take up maybe 10% of this entire room, but that's all we're mining per day. Because we're basement hosted, we have a basement hosted deposit, we're also able to put our tailings underground. This is, again, unique in the industry. There's not many mines out there. I think there's one other mine out there that's doing an underground tailings deposit. So we have minimal footprint, and then we're also have very minimal environmental risk with all of our tailings underground.
And Tim, I guess the same question to you. You know, you are probably the highest grade deposit in Africa. You know, mining off an underground approach off a decline. Do you want to talk also to the point of how important that is for your tonnage movement and disturbance?
Yeah, absolutely. We're also looking to mine at the rate of about 1,000 tons per day, and it's an underground mine. What we'll be doing is putting half of the tailings will be going underground. So half of what we bring up from underground will go back underground, and the balance will be used for construction on site. So again, it's a relatively low impact operation, benefiting from high grade there and allowing us to, you know, minimize the impacts for on the ground and for the area surrounding us.
Okay, that's great. I guess when we're we're not just trying to appease shareholders and investors with respect to being respectful of the environmental footprint. It's obviously the community as well. Monica, NexGen has made some phenomenal moves forward in community engagement in the Athabasca Basin with the communities there and First Nation. Can you just talk to the progress you've made and why that's so important and what needs to be done going forward?
So we've been engaging with the communities before we even started drilling. So before in 2013, we were engaging with the communities, and part of that reason, they own the land, they're there before us, they're the indigenous communities, and we want to make sure that they're benefiting from the land that they actually own. So we were putting in programs like a breakfast program and providing breakfast for 1,000 school children per day. And then we're also providing training programs so they can have lifelong skills, and that it could benefit potentially our mine, but also lifelong skills that they can bring forward to other areas wherever they choose to live. The way that we've gone about our community relations has really helped us with our environmental assessment. And even so much so that the indigenous communities are vouching for this project. They're going to Parliament and speaking on our behalf, saying we want this project permitted today. So it's gone a very long way, and we've done such tremendous things that the government is applauding what we're doing in the area.
And are you finding that you're setting the standard for others who have maybe not taken that as seriously in the region?
Yes, definitely. I think we are setting a new standard, being talking to the community before you even start drilling. I think that should be, the new standard of mining. Mining has come a long way in general. I think mining's leading the charge on ESG compared to other industries out there. But I mean, in terms of setting a standard, we think, doing best practices for community engagement and environmental engagement should be, a priority.
And Tim, obviously Africa, a mining project can make or break communities with respect to job opportunities and what have you. You're in a country where the French have been mining there for a number of years. They've just recently shut down a mine. How important is what you're doing viewed by the community and the opportunities that's giving them?
Yeah, it's viewed as very important by the communities and also the regional and national governments. Guys referencing Orano, the French nuclear company, which has been mining in Niger for 50 years, and just 100 kilometers north of us, they had two mines going, one of which just got mined out and closed after 50 years, about a year and a half ago. What that's done is that's left a hole in the budget of the national government. Niger is ranks at the low end of the UN Development Index and needs the money and feels the absence of that revenue stream, which would be royalties and tax and other fees. But so too to the city north of us there, they're feeling it too, because 800 people had lost their jobs when that mine shut down. So what we've been able to do is hire the executive team that ran that mine, which was really good news for us, obviously, from an project execution standpoint, but also good, of course, for the continuity, the social economic stability to the region, the city. And we hope to hire up to 450 of those laid off miners. And so again, this is really welcome news for the government. They're cheering us on, and like Monica's experience in Saskatchewan, the area people around us, known as the Tuareg, they too are cheering this on, because like any rural settlement, they're losing young people to the cities, and so here's an opportunity for us to train and hire up some of these young folks, which we're doing as we speak. We have mentoring and training programs underway at the moment.
I guess that brings us around to jurisdiction as well. I mean, there's like all mining projects, you can have a great ore body, but if you're in the wrong part of the world, it doesn't help you too much. Niger has been a uranium producing country for a long period of time. How do you find the government support there, and what are they doing to help you progress the project?
Well, there's no doubt that the jurisdiction has its challenges. The government is our partner in this project. They own 20% of the project, we're the other 80%. And we sit collectively with board of directors, et cetera, and work together on any and all issues and challenges. There aren't any, there are no impacts on us where we are. We're right in the middle of the country. There have been raids over the border at the east end and the west end, typically raiding area villages proximal to the border and then running back over to say Mali or Burkina Faso or Nigeria. The government has stepped up its coordination with both the French military and the American military, both of whom have large bases in country, in order to stand these people down and to help the government establish or maintain security on the border regions. Inside, it's solid. It's the only democracy in the neighborhood, and we've found it to be a great place to be. We've been there since 2007, over which time we've got to know different governments over the years, and nationally, regionally, and locally. So it's for us, it's been good, and for Orano, it's been good for 50 years.
And Monica, obviously, Athabasca Basin, a prolific uranium region of Canada, been production there for a number of years. You guys are on the west side of the basin. There's a little bit less infrastructure there. How do you find discussions with the local politicians, bureaucrats? I mean, how are they progressing and helping you progress with respect to everything else that needs to come around that mine as you start to make a decision to go into production?
Well, there is a mine in the area. So a highway runs through us, actually. So there's a mine called Clough Lake. So we do have decent infrastructure around us. The province has been very supportive. Saskatchewan is rated #2 globally on the mining scale. They're very pro-business. They love what we're doing. They even came out with the Saskatchewan First Act, meaning that they want to bring minerals and they want to be a critical mineral hub and clean energy hub for the world. We've seen support as well from the federal government. So with the Critical Minerals Act and their support for uranium, SMRs, and nuclear power in general. Yeah, it's very good support from the federal and provincial side.
All right, let's talk money. So obviously building a mine is not cheap and it takes money. Tim, you guys are in discussion with some debt finance providers at the moment. It's probably the first time in a decade that there's been serious discussions around project debt financing a uranium project. How are you finding that journey? Has there been an education process to bring those debt providers up to speed with the uranium story? And do you think that there's others watching closely to see how successful you are as they look also to have similar discussions?
Well, starting with the second point first, I think many eyes are on us and how this is playing out. To the first point, with the development banks, we're dealing with two. One of them is the Economic Development Bank of Canada. Another one's a U.S. group that prefer to be named, after we go firm with everything, which we anticipate doing in the current quarter. It was interesting. The development bank side is they looked at the uranium, and they hadn't done a uranium project before, but they came around to the thinking on it that this was indeed a source of low carbon baseload power that was totally in sync with overall net zero and green initiatives overall. And they were also keenly focused on the outsized role of a big mining project such as ours that will play in a developing country. So again, on the national, regional, and local levels, and they were quite keen to be part of that. And No, it was refreshing. We were surprised by the uptake there. I will say that the journey has been lengthy. We've been dealing with the same two groups for about a year and a half or thereabouts. Through that process, they do a very exhaustive audit of, on the one hand, the plant, the project, the mineral deposit itself, but then on the other hand, the ESG components. So everything from our CSR initiatives in country, which we've done sort of things that you might assume that we would have done: drought relief, food, medical, training, education, things of that nature, infrastructure like water wells, but also the management policies, the HR policies, and everything with a view towards Equator Principle 4 and International Finance Performance Standard compliance. And really that compliance with those standards is a prerequisite for going ahead with the development banks. They simply won't fund you unless you are well along the way towards compliance with those standards, and then they back it up with an agreement whereby, you know, they put you on a grid, they'll essentially mark you on where you are and come up with an ideas about what you have to do to get where they want you to be in terms of compliance and over what period of time, and put that into a legal agreement. So performance against that is a requirement to draw funds under the loan. So very comprehensive, but at the same time had the effect of auditing our project, you know, inside and out, top to bottom, which is good for everybody, I think, and should bring a lot of comfort to anybody looking at us as a potential investor, and impacts that we're going to have on the ground and contributions to the country going forward.
And Monica, I mean, I guess, you know, you guys are having discussions. It's a much bigger check to write, but it's an incredible scenario with your project where the money's almost being paid back before the ink's dried on the contracts. How is that conversation going with potential debt providers where that the payoff is so fast for them that, you know, are they wanting to stretch it out to have skin in the game for longer? I mean, it's a really interesting predicament that you're in, because it will, when it starts producing, just the debt's not there for more than a year or two, right?
Yeah, so they'll stretch it out for 7 to 10 years. So our CapEx is about 1.5 billion with working capital, but our payback period is 11 months, and that's at current spot prices. So when a debt provider looks at that, they are pretty comfortable with providing debt. We could be 100% funded by debt. We're choosing to go with 65 to 70%. We're having ongoing conversations, and we'll have a better idea by the end of this year what this looks like. But we're speaking to similar groups, EDC Canada, for instance. Being involved in a tier 1 project in Canada is, in terms of a global image for Canada, it's huge. So we're speaking to groups like that, as well as free money groups. So the Strategic Innovation Fund, as well as groups like the pension plan providers, global banks, national banks. Yeah, so the conversation is fluid, it's ongoing, and it's looking like it's going to be quite easy to finance.
So 11 months payback at $50 odd. Fast forward 2027, if we're still at $50 odd, we've got a problem. You know.
Agree.
Wow. And are you getting the sense, either of you, that there's a finite appetite for debt financing for uranium projects? I mean, my previous life, I worked at banks, and we would have commodity limits on project and debt finance, where we'd say, you know what, there might be 10 great gold projects, but we've only got appetite for 6 or 7 of them, and we need to then go and find something else to just diversify commodity. Do you think being first mover and being such a bellwether opportunity, that gives you the advantage that maybe the others are going to struggle to find that appetite? Or do you think the fact that you guys are moving in this field and there's education and upskill may make it easier for the others as they come through?
I think it'll be easier for the others. I mean, at the end of the day, we're in a supply deficit, and all the Western governments, globally, we're seeing an adaptation of uranium and nuclear power. So if we want to decarbonize and if we want to have energy security and affordability, we need nuclear to be part of the conversation, and we're seeing it legislated across the globe. So in the US, for instance, with the IRA, in Canada with the Critical Minerals Act, in Europe with the Industry Act, it's everywhere. So to finance these projects, and there's not many of them at the same time. So since the last cycle, there's only been 3 new uranium discoveries. That's ourselves, ISO, and fission uranium. That's it. And everybody else is the same. It's all brownfield or existing. So yeah, I think they're going to be easy to finance these uranium projects if we want to decarbonize.
I think in the last cycle, there was an analyst who's still around who was writing back in 2009 and 10 that there'd be 27 projects coming to market. I think 7 of them made it. But anyway, I guess you can't talk about financing without sort of bringing up the C word and talking about contracting. You both have different approaches to that. Tim, maybe you start there on what requirements potentially are around contracting some of your production so that there is cash flow visibility on paying back the debt and what's happening in those. And then maybe Monica, we can then talk about the NexGen approach to utilities and contracting.
Sure. We've got contracts with 2 utilities, 2 North American utilities, roughly 4.5 million pounds, excuse me. And that's 2/3 of what the bank would like to see us have before we go forward with the loan and draws under the loan rather. So we're well along the way there, and the financing, it's interesting, the pricing rather, a half and half base price and then a market component, which would have a floor and a ceiling. And so all pretty standard, I think. What surprised us was that we were able to write these contracts, quite last year. So that would be a couple of years before we're going to be in production. So I think it speaks to the supply dynamics in the market as a whole, but also to the interest now occasioned by really Russia and Ukraine, of course, of diversification of supply. And that really what that's amounted to for us is that we're actually getting calls from utilities, which is, really sort of the shoe's a little bit on the other foot there, and pleasantly surprised by that. Even with offers of prepayments under the contract. So I think it's a strong market. And I think to Monica's point, there's YCA.L government support for uranium and acceptance increasingly so society-wide of the key role that uranium is going to play in low carbon baseload power.
Monica?
So we'll be contracting on volume, and that we're going to be basing it on the spot price at time of delivery, which is different than majority of the players out there. And part of the reason for that, we don't think $50 is the right price. The pendulum is swinging in favor of the miners. There is an undersupply in the market. We think it's going to be going much higher, and we do want leverage to the upside of uranium. Also, just because of the way our deposit is hosted, being in basement hosted rock, we can be flexible on our supply. So that really dictates our contracting strategy. You can build a cathedral down there and it won't collapse. So that's another benefit to the deposit itself. But we saw the same sort of thing play out in the lithium market, for instance. So a few years ago, you needed a collar, you needed a fixed price. And now all the lithium suppliers have the balls in their court, really. And we saw the price move from 50 to 500, 5,000 plus. So we're seeing the same, we think the same sort of thing's going to happen in the uranium market. We don't think that $50 is the right price. We think it's going to be going north of 100.
Oh, so I guess, what have we got? 4 minutes left. That's the question is, so when we're sitting here this time next year, where will the price be? And where will your stock prices be?
Well, contracted prices that we saw with like the US Strategic Reserve were from 59 to 70. So I think it's going to be north of 75 personally. That's the incentive price in the US around that $75 mark. and where we're going to be, hopefully multiples of where we are currently.
You know, that sounds like just a great answer. And I think I'd say pretty much the same thing. 75 is our internal near-term target, and pricing's up to the market.
And it's $75. Both of your companies are spitting out some pretty significant free cash flow there. I think we fairly close. All right. So I'd just like to say thank you to Monica. NexGen is a publicly listed company on the Canadian, US, and Australian exchanges. So you can find them there. Global Atomic is listed on the Canadian exchange. They're both part of the Tribeca Nuclear Opportunities portfolio as well. So I'd like to, unless there's any final closing comments that we're just needing to get out into the audience here. Any final things to say?
Thanks very much for having us.
Yeah, thanks very much. And I guess we're just entering the new nuclear renaissance, and this is just the beginning.
Well, I look forward to being back here this time next year with not a spare seat in this crowd as everybody's clamoring to catch up with the thesis. So thank you, everybody, for your time. I really appreciate that. And thank you, too, for joining us up here.
Thank you.
Yeah.
Thank you very much, Guy. Thanks, Monica, and thanks, Tim. We can just jump you in the middle for a picture, and we've got Marcus and my crew running onto stage. They're going to grab the chairs, etc. when that's done. I loved your last question. Anything last to stay in true Canadian style? It was something polite. Thank you very much. Thank you, guys. Thanks so much. Put your hands together again for Guy and guiding our fireside chat for us. So we've got half an hour worth of more educational information for you here in Auditorium 1. I've just popped over to Auditorium 2, and there's been some great presentations in there this morning as well. They've got 2 more to go. So they're going to marry up with us, and we'll all be going out to lunch at the same time today. So I have got leading the charge here. We've got from Tribeca, the wonderful John. Tribeca, did I give you the wrong organisation? No, you are. Come back here so I can read you closer to me. So John Stover's coming up. So John is a portfolio manager for Tribeca Investment Partners. And if you were here first thing in the room yesterday morning, you would have heard his inspirational speak. He kicked us all off for the conference yesterday morning. Joining him on stage from Blackstone Minerals, we have Scott Williamson. Pan Asia Metals, there is Paul Locke. From Merdeka Copper and Gold, we've got Andrew Starkey. And Justin did make it in. Good on you. And we've got Justin Werner here as well from Nickel Industries. So this is our panel, our esteemed leader, and we've got half an hour. So again, Tim, I'll give you a wrap up at about 5 minutes to go. And we're going to have a lunch break today. Our lunch break will run through to, I think it's 1:25. So between 1:45 and 1:25, we'll have a nice, decent lunch break, and that'll give us time to get in and get invested in the afternoon. We've got one more panel session. And we also have, of course, our conference closing cocktail parties today, thanks to the Lind partners. And we look forward to you all staying around with us and having a chat about what you've seen. And it was really interesting when I came in this morning to see a couple of you in here bright and early. You'd beaten the traffic in, and you were there with your computers. So what are you doing? Are you a journalist? Are you reporting on what's happening here today? Because we've got a lot of international journalists at the conference. And they said, no, we've actually taken notes, and we're just writing up our notes from yesterday. And we're getting ourselves ordered today so we can hear all the information and hear all the opportunities. So here is another one for us. John, over to you. And thank you so much for agreeing to chair this panel for us.
Thanks a lot, Chrissy. And thanks everyone for joining. Really excited to be a part of this panel. We have 4 distinguished speakers from Southeast Asia here that are representing a few different countries. So we have Justin Werner, who's Managing Director of Nickel Industries, and Andrew Starkey, who is Executive Chairman of Merdeka Battery Materials. They are representing Indonesia. We have Paul Locke, who's Chairman and Managing Director of Pan Asia Metals, and Scott Williamson, who is Managing Director of Blackstone Minerals. So I think Southeast Asia actually has one of the most interesting and exciting stories in the energy transition globally. We've obviously seen, historically it's been thought of as a commodity producer and a natural resource exporter, but increasingly we're seeing a lot of really exciting and interesting downstream stories in the region. Indonesia obviously has invested multi-billions of dollars into its nickel and cobalt processing value chains, increasingly looking at going into batteries and even EV auto manufacturing. And we also see in Thailand and Vietnam, for instance, there's already a robust audio manufacturing industry, and a couple of the companies here are looking to feed into that value chain. So what I'd like to start off with, and we'll just go down the row here after quick intros from each of the panelists on their companies. But I'd like to ask the first question after you give that introduction, which is, we've obviously seen a lot of discussion around Inflation Reduction Act and the impact that it's going to have on this industry, the advantages that it's going to give U.S. and free trade agreement producers of battery minerals, potential bifurcated pricing. So, that obviously could put Southeast Asia producers at a disadvantage. But what I'd like to ask is, what are the advantages of being a Southeast Asia-based producer of battery minerals that could potentially mitigate those impacts? So, Scott, why don't we start with you?
Yeah, thanks. So yeah, we're very lucky to be operating in northern Vietnam. It's the previous operating Ban Phuoc nickel mine. One of the real benefits we have is we have abundant renewable hydroelectric power, and that's puts us in a really strong position compared to our peers, and particularly from the electric vehicle industry. So there's a real focus on net zero carbon or low carbon nickel, and we have the ability to achieve that from day one. So yeah, that's probably the key benefit of operating in northern Vietnam, and also the competitive labor costs as well. So and the skilled labor. So some of the best skilled labor we've seen in any emerging market in northern Vietnam.
There we go. Thanks, John. Paul Lock from Pan Asian Metals. Our big focus is costs. So in Southeast Asia, the reason a lot of manufacturing comes to Southeast Asia is because it's a low-cost environment. It's got a highly skilled workforce. Where we are in Thailand, the largest auto producer in Southeast Asia and the fourth largest in Asia, we've got an emerging EV and LIB ecosystem. And as John mentioned at the start, there's a lot of opportunity to feed into that. So that's the opportunity we see.
Hi, John. Thanks for having us here. It's Andrew Starkey from Merdeka Group. Merdeka Battery Materials, this is our Indonesian listed nickel themed EV battery materials company. The company's listing on the IDX on the 18th of April. We've just closed the books, so a new chapter for us as we take this company to market. In terms of asset base, our large asset is the SCM nickel mine. It has approximately 14 million tons of contained nickel in the resource. So our big challenge is, how do we monetize such an enormous resource base in the near term? So very much focused on the downstream processing opportunities and the value adding opportunities as our nickel goes through in the EV battery material chain. At the moment, we have RKEF plants producing both nickel pig iron and a nickel matte conversion option there. And we also have announced a recent joint venture with CATL from China regarding an HPAL plant to produce MHP, one of the key intermediate materials in the EV batteries chain. Just addressing directly then that question regarding why we think Southeast Asia, Indonesia, in our case in particular, is a sensible place to be based for this activity. Indonesia's participation in the nickel global production share is continuing to grow. It's more than 60% at the moment. That's scheduled to increase. So simply by proximity to nickel, Indonesia will be playing a role for decades to come in the processing of that material. And then when it comes to costs, sharing with the other speakers here, we see that our CapEx and OpEx costs are a fraction of conducting similar activities in other jurisdictions. So that locks in margins for us on very fundamental reasons that we think will last the duration of our assets as well. So thank you.
Thanks, John. Justin Werner, Nickel Industries. You look to go to the advantages of being in Indonesia. I think as Andrew's highlighted, it's simply the significant resources that exist, and still many areas are underexplored. You compare that to sulfide deposits, which, if you look globally, consistently larger and larger exploration results or new discoveries are getting harder and harder. Whereas laterite, there is an abundance, it's right on the surface. And so to Andrew's point, it's then we've got this abundance of nickel,
how do we process it in a cost effective and environmentally friendly way. That's another advantage that we have in Indonesia. There is significant renewable power opportunity. Vale has operated with a very large hydropower facility since the 70s. We have a 420 megawatt peak solar project, which we're in the stages of implementing, and we've successfully implemented one at our mine, which reduced our diesel consumption by about 31 million tonnes a year. Another advantage that we have in Indonesia is obviously very supportive policies from the Indonesian government. So our operations have tax holidays that range anywhere from 7 years to 15 years of zero tax. And so as a result, very strong cash flows. We sit right at the very bottom end of the cost curve. And the final advantage is that some of these industrial parks that have been built within Indonesia, the significant infrastructure that exists there now in terms of port, power, trained workforce, that allows a lot of these projects to be rolled out with a CapEx guarantee, and obviously a tremendous value in that, given particularly if you look across the battery metal chain, there has been significant CapEx blowouts that have been recently announced by a number of players in that space.
I think just out of interest, both Nickel Industries and Merdeka's assets are in a similar region, and the timeframes that we can get these new downstream processing plants constructed in these pre-permitted industrial parks is really astounding. 2-3 years from a vacant site to a high margin project. So that's one of the advantages. These mineral processing industrial parks, of which there's around half a dozen sizable ones in Indonesia, have really become a portal for getting your projects up and running quickly. And you can remove permitting, licensing, etc., from the critical timeline. It's a pre-packaged arrangement to a large extent.
Yeah, absolutely. Thanks for that. And I agree. It's just been incredible to watch. I was on site there in August, and the scale of things and the quickness and how quickly they go up. Certainly a lot of advantages to being in one industrial park. I'd like to ask maybe Scott here. So we've obviously heard a lot this week about auto manufacturers looking to go upstream, battery manufacturers looking to do upstream deals. What do you think? And I know you've had some discussions with downstream players as well. What are they looking for when they look for an upstream partner?
Yeah, so it's interesting. We've been on this journey for 3 or 4 years looking for a downstream partner. We've focused our efforts on South Korea. When we started that process 3 or 4 years ago, it was all about nickel and any nickel, and now it's the conversation has moved to low carbon nickel, and we believe that's being driven by the European car manufacturers. So that's being pushed into the battery industry. There's a real focus on a clean nickel product. I think jurisdiction is important. So the South Koreans are very happy to invest in Southeast Asia, and I think they understand Southeast Asia as good as anyone. So they're very happy to invest in Vietnam and obviously Indonesia as well. So it's a real focus on a clean green product and ESG compliance. Whereas 3 or 4 years ago that wasn't in the conversation. It was just about any nickel. Now it's definitely, the conversation has changed considerably.
Got it. Thanks for that. And I might come back to the guys with Indonesian assets. So obviously both of you are looking at HPALs. That's been something I know it's a newer technology. There's been some questions around viability, et cetera. Also, obviously much lower carbon emission intensity. So can you guys just talk through your decision-making process there when you looked at the HPAL and why you've decided to move ahead with it? Justin, maybe we can start with you.
Look, we've moved ahead with a 10% acquisition of the Huayu nickel cobalt project, which was the first project to successfully commission in the IMIP. Has the world record for the fastest build. It was built in a little over 18 months during the COVID pandemic. Lowest OPEX and lowest carbon intensity. So the current carbon intensity is around 6 to 7 tonne of carbon per tonne of nickel. You compare that to pyrometallurgical processes, which sit around sort of 60 tonne. You can see it's the carbon intensity is very attractive, but not only that, Huayu has a clear plan to be net zero by 2030. why is the carbon footprint so low? It has the world's largest sulfuric acid plant, which generates a significant amount of heat in the production of the sulfuric acid. And so in that allows for the generation of power. YCA.L also is being heavily supported by the government. There's been tremendous growth in nickel pig iron capacity in Indonesia. But one of the side effects of that has been that in order to get access to the high grade ore, a lot of the lower grade limonite ore that sits at the surface has been discarded. And as a result, we've seen a reasonable amount of that has been sterilised. So the Indonesian government, in its wisdom, recognised that this wasn't sustainable. There was a very valuable resource sitting at top that delivers not just nickel but also cobalt. Chrome can also be extracted and other elements. And so we see it as very attractive. You only have to look at, obviously, Ford has just recently concluded their agreement with Vale and Huayu in Indonesia. And look, I expect to see more global North American, European OEMs looking to Indonesia to shore up security of supply, because it really is sort of as Andrew outlined, more than 50% of global nickel comes out of Indonesia currently, and that will continue to grow.
I think all the good points were taken. Maybe some anecdotes so we recently ran an informal process on who would partner with us on our YCA.L plants, and it became apparent from that exercise that the interest in investing in Indonesian YCA.L plants, North Asian, European, North American, it's extensive. Their interest is in securing a stake in the MHP, in that material, precisely the basis for Ford's recent investment decision. So for the OEMs and the industry participants, it's clear it's access to physical offtake. For a company like ourselves and Nickel Industries with these large resources that we're looking to monetize, of course, YCA.L is the highest margin route to do that. And the economics on these plants are really quite astounding. The future margin of the MHP product, that's for people to take their view on the demand and supply of that product. But the payback period on these multi-billion-dollar assets is very rapid. So the decision to invest is really around certainty of the resource to feed into that plant. Once you've ticked that box, then you're looking for partners that have had success with the technology. And I think we are now clearly in the 4th generation of the YCA.L technology. We had this question a lot during our IPO, just how confident are we that these plants can operate? The plant that Nickel Industries is taking a stake in is one of the great benchmarks now in Indonesia to show, I think, well above nameplate capacity production. Costs are shaping up. So I think it's that maturity of the technology now that has crossed over that threshold point.
Yeah, great. Thanks for that. And maybe we touch on Thailand. It's obviously not traditionally seen as a lithium producing country, but I'm curious how you see the industry there or in your projects. How do they stack up to some of the projects we've heard about in say, Australia or South America?
Well, John, our projects are smaller, but it's not really about project size or project grade. And this is where I think a lot of investors go wrong. It's very easy to look at tons and grade, but the reality is it's where you sit on the cost curve. So we were talking about, or you mentioned OEMs and what they're looking for in a project. In our discussions, you're actually looking for position or potential position on the cost curve, because it's no use going down the path with a high cost player. And then when the commodity cycle turns, and all commodity cycles go through the cycle, they find that their partner can't actually deliver. So on the question of OEMs and what they're looking for, or in our case, chemical manufacturers, they're actually looking for certainty of supply, and that includes certainty of supply in the price cycle. The Thai chemical market is extremely deep. It's one of the largest chemical markets in Southeast Asia, and there's a lot of opportunity to produce specialty chemicals for batteries.
Great, thank you. And I guess from your perspective as well, in terms of, we've heard a lot upstream versus downstream, and I think most of you have a variety of ambitions. Everyone has an upstream resource. Everyone has some ambitions to go downstream. How do you think through that in terms of, maybe Scott, how do you think through that in terms of where the value sits, where the margin sits, Is it unique to each different product? Does it depend on your partners? How do you go through that with your board?
Yeah, so our decision was pretty easy because there's a tariff on nickel concentrate in Vietnam, so we weren't keen to pay that. So we went downstream from day one, and what we found is that the chemical industry needs chemical products. So nickel concentrate isn't really a product that can be fed into the lithium-ion battery chemical cathode industry. So very quickly we realized we needed to convert that concentrate into a chemical product. So we're looking at a MHP intermediate and then going to nickel sulfate. We then combine the nickel sulfate with cobalt and manganese sulfate to produce the NCM 811 product. So there's a lot of value add there, but to do that, we do need partnerships with downstream players. So it's important, if you want to move into the downstream, you have to build those strong relationships. And that's why we've spent a lot of time in South Korea, understanding exactly what products and what specs are required for those downstream chemical products. And yeah, it's definitely worth the effort, and there's a real value add there. But yeah, it does take a lot of time, and yeah, the partnerships, are ongoing, and we continue to work on them. But it's definitely a work in progress for us.
I was going to ask Justin, actually, in terms of, I was quite surprised and pleasantly surprised that you guys were able to get the nickel matte conversion up and running that quickly, and it seems to be going well with the margins. But could you talk through that in terms of being able to toggle between the stainless steel demand and the battery value chain, and how big can nickel matte get for you guys?
Yes, so the nickel matte is an interesting one. Tsingshan's been the first company to successfully take rotary kiln electric furnaces that historically could only produce NPI, which is a class 2 product and can only be sold into the stainless steel market with a minor modification, but the IP sort of sits in the all specs and the temperature and conditions they run the furnace at. They were able to produce a low grade nickel matte, which could then be put through a converter to produce a saleable high grade nickel matte. And the margins obviously currently are much stronger. Our NPI margins from similar kilns producing NPI last quarter were about 2,250. Our margins from nickel matte were almost $6,000 a tonne. So there is a big margin differential currently. So the ability to swing production between NPI and between nickel matte we see is very valuable. It does have a higher carbon footprint, and so it's not going to be applicable to everyone. And that's really why then the further diversification into the HPAL in the new plant that we're looking at building, that will go further than just MHP. It will go all the way to nickel sulfate and as well nickel cathode. So really a sort of a diversified suite of products, which will give us exposure to all the key elements of the nickel market and their different sort of supply demand fundamentals and pricing that we think will play out over the sort of coming years.
Yeah, great. And Paul, I think you had something to say on the upstream versus downstream.
I was about to say the key word is exposure. So we made the decision to go downstream really early in the piece. And one of the key reasons is that lithium's hot and in short supply. So you've got a different dynamic when it comes to working with knowledge partners. So we call the partners knowledge partners. We're bringing the product, they're bringing the IP, and we're looking to do 50-50 sort of joint ventures. But the reason we want to move downstream too is that the further you move from the concentrate, the less volatility there is in your margins and the more customers you get, and then it gets to exposure. So your face or customer face starts to expand, and as your company grows, there'll be new opportunities for M&A or development or other partnerships. So that's really our key driver.
Got it. Thank you. And in terms of, I want to touch on capital markets as well, because, we obviously have 3 Australian listed producers that actually have assets in Southeast Asia here. Andrew has gone through an IPO in Indonesia. And maybe, Andrew, you can touch on your experience there, because I'm curious, we heard from the SGX this morning, it seems like a region that's ripe for more listed companies in this space. What was your feedback from investors?
Yeah, I mean, it was one of the early considerations whether we continued with an IDX listing. Of course, Merdeka Copper Gold, the foundation mining business, is IDX listed. That's gone well for us in terms of market research, follow-on capital raisings, general positioning the company. We have a number of IDX businesses in the portfolio, so that was the obvious choice for us. There is a sector there. There is a grouping of analysts, investors, particularly in Indonesia, that are just aware of the significance of the sector to Indonesia. So of course, the dozen or so listed coal companies probably set the scene. Now we have gold, copper, and nickel listings. One of the interesting aspects that came out of the investor discussions recently is probably this idea that if you're sitting in London or New York and you want exposure to copper or gold, you don't have to go as far as the IDX. But now if you do want exposure to nickel and some of this downstream processing, you can go to the ASX, and you should probably also have a look at the IDX now as well. So we've seen a number of investors take interest who previously had never considered in their portfolio IDX investments. So I think that's an interesting feature of the way the nickel sector is going, the listed nickel sector in Indonesia.
Yeah, thanks.
What about liquidity? And where are your core investors coming from in the IPO?
So we list on the 18th, but our existing business, I think at different times we've been in the top 3, top 10 most liquid stocks on the IDX. So anywhere from $20 to $40 million US a day of traded volume on the IDX. The investors, that there's a strong support of domestic investors. So there are, I mean, Indonesia is a big country. You've got lots of pension funds, insurance companies, high net worth individuals. And then we probably have about 10 to 15% of our register are international investors. So particularly out of Europe, the UK, and then perhaps North Asia and elsewhere. It has taken time to build up that breadth of investors. Certainly at IPO with our foundation company around 6-7 years ago, it was very Indonesian focused. So it's been a concerted effort to broaden that.
Great. And in terms of, I guess, government support, so what are governments feeling about this sector in the region? Justin, maybe you can touch on from your perspective. Obviously, the Indonesia nickel ore export ban kind of kicked off this whole downstream move in the first place. There's always things in the press about potential different changes to the law, et cetera. I mean, what's your feeling from that side?
Yeah, I think the Indonesian policy has been extremely successful, and it's a rare example of a government actually taking a long-term view. I think when they first banned the export of raw ore, everyone said, well, A, it won't happen, or B, they'll pretty quickly reverse it because they'll realize all of the revenue that they're losing. Fast forward only a few years, barely 10 years since that policy was enacted, and you look at the actual and now sort of committed investments, somewhere around 70 billion US. And as I mentioned earlier, the names that you see that are now invested and breaking ground in Indonesia. Now we've touched on Ford, Hyundai and Mitsubishi have broken ground on the first electric vehicle plants in Indonesia. BASF has broken ground on a battery plant. The names, Tesla has been on a number of visits and is having a very hard look. VW has MOUs. So, and I think what the government has provided is, coming back to the sort of difference of listing between the ASX and the IDX, we unfortunately still get discounted for that perceived sovereign risk, even though we have a very strong partner, both Chinese and local. But that's just a reality of the market that we exist in. But look, I think the government has made all the right decisions, particularly when you look now at sort of developing the limonite resorts and the HPAL. They said no correctly to deep sea tailings as a possible option for management of tailings. So as a result, they've forced everyone to go to dry stack tailings, which is the best solution that, for any tailing storage. So look, I think the government has done a great job. And not only that, the policy is actually carried through changes in government, which is also, very important, because that's also one of the key risks that
we get asked with, well, there's an election coming up next year. What happens if we get someone who's, you know, not so friendly to all of this foreign investment?
And Scott, what about from your perspective? What sort of interactions have you had with the government?
Yeah, so we've also have very competitive tax incentives in the early years. So 0% in the first 4 years, 5% in the next over the next 10 years. So we've got a government that is very much incentivizing foreign direct investment and also very keen to build out the battery supply chain. We've got a local electric vehicle company, VinFast. They've also built a battery plant recently. So yeah, not quite to the same scale as Indonesia, but we've got a similar government of very supportive government and a similar opportunity. So unfortunately, we don't have as much nickel as Indonesia. So we'll see how it plays out. But yeah, we've definitely got a very supportive government in Vietnam.
Beautiful. Well, look, I think that covers most of the main topics. I know we're running up against lunch here, so won't keep everyone from the food, but thanks very much to the panelists here today. Appreciate your thoughts, and thanks everyone for listening.
Thanks very much, and we'll just keep you up here for a photograph if we can. And as you're making your way out the room, the program for the afternoon includes, we've got 4 companies presenting in here, including you, Scott. So I think you're sandwiched in the middle there. So we've got 4 companies for you to hear from. We've got another panel